Hello everyone, welcome back to Business Unboxed. Today we are diving deep into a topic that affects millions of middle class families across the nation, the income tax burden and how it has evolved over the years. So if you are a taxpayer or just curious about how these changes impact your wallet, stay tuned. The government sources recently claimed that income tax burden on common man has come down in the last 10 years thanks to the government's various measures. They claimed that taxpayers in the rupees 2.5 to 7 lakh tax bracket who paid on an average rupees 25,000 equivalent to rupees 43,000 after adjusting for inflation in FY14 are now paying zero tax. Even those in the rupees 7 to 10 lakh income category, the average tax they paid in FY24 was only rupees 43,000. Has the tax burden on middle class indeed come down? Let us do a reality check on the government's claims. To understand the impact of these changes, let's take a look at the income tax scenario from FY14 to FY25. In FY14, an individual earning rupees 2,50,000 was not liable to pay any tax after considering available rebates. Fast forward to FY25 and the basic exemption limit under the old tax regime stands at rupees 5 lakh. This shift illustrates the government's recognition of rising living costs and its attempt to alleviate some of the financial burdens on taxpayers. The introduction of the new tax regime has been a game changer, particularly for those with incomes up to rupees 7 lakh who do not pay any tax. For salaried employees, this threshold rises to rupees 7,50,000, marking a significant step towards making tax compliance easier. However, while the new tax regime has simplified tax calculations, it is essential to understand that the benefits may not be as substantial as they seem when adjusted for inflation. Now let's delve deeper into the numbers. In FY14, individuals earning rupees 7 lakh paid a tax of rupees 70,000 and those with an income of rupees 15 lakh faced a tax liability of rupees 2,80,000. In stark contrast, by FY25, taxpayers earning rupees 7 lakh are exempt from tax while those earning rupees 15 lakh pay only rupees 1,40,000. This significant reduction in tax liability highlights the government's intention to provide relief to taxpayers. However, one must consider the inflationary impact of these changes. Assuming an annual inflation rate of 8%, the rupees 2,50,000 threshold from FY14 would equate to approximately rupees 5,13,000 in FY25, while the government has increased the non-taxable income limit to rupees 5 lakh. This change essentially aligns with inflation rather than providing genuine tax relief. If we change the assumption of inflation rate from 8% to 11% per annum, rupees 2,50,000 in FY14 nearly becomes rupees 7 lakh in FY25. As such, the increases in basic exemption limit and corresponding tax reliefs appear largely inflationary in nature and not in the nature of extra concessions given by the government, though the new tax regime has certainly eased the compliance burden for the taxpayers but has not granted significant tax savings in the real sense after adjusting the effect of inflation. Tax experts argue that while it may seem like tax liabilities have decreased, inflation has largely negated these savings. So when analyzing these figures, it is crucial to look at them in the context of the overall economic landscape. As we look ahead, experts are suggesting that the government should consider easing tax rates in the new regime. With the Income Tax Act set for a comprehensive review in February 25, there is a possibility for substantial changes in the near future. So with this, we have come to the end of this episode. If you found this video informative, don't forget to give us a thumbs up, share your thoughts in the comments below, and subscribe for more insights on financial matters. Thanks for watching, and we will see you in the next video.